Welcome to Exponential Finance, where we connect AI, cryptocurrencies, and markets to help you understand what matters and how to act each week. Today, we present a very interesting analysis by Jordi Visser. So here's what we're diving in today. The markets are feeling pretty tense, right? So we'll start there. Then we'll tackle the big AI bubble debate, look at this weird new kind of recession we might be in, unpack what's going on with Bitcoin's latest crash, and then wrap it all up with how you can make a disciplined bet in the middle of all this chaos. All right, let's jump right in. The feeling out there is fear. You can taste it. But the secret isn't to just ignore that feeling. It's about learning how to move past those gut reactions and start thinking in terms of probabilities. I mean, look at this. This post went completely viral, and it's easy to see why. It hits a nerve. It perfectly captures that massive disconnect so many people are feeling between what the news says the market is doing and the real-world pain they're seeing in their own accounts. It just feels brutal. But here's the wild part. Let's look at the actual numbers. The S&P 500, it's only down 5.6% from its all-time high. That's it. Technically, that's just a minor little correction. And yet, that tiny move has unleashed this massive tidal wave of panic. So how in the world do you navigate an environment like this? Well, we need a better mental model. We're going to borrow a fantastic one from Annie Duke called Thinking in Bets. The idea is actually pretty simple, but it's incredibly powerful. You treat every single choice you make not as a sure thing, but as a bet. A bet you placed based on evidence and probability, not on fear. It's honestly the perfect tool for keeping a clear head when everyone else is losing theirs. Okay, so let's put this framework to the test. We're going to tackle the absolute biggest fear haunting the market right now. This idea that we're in some giant, out-of-control AI bubble that's just seconds away from popping. And you've got two camps fighting it out here. On one side, you have these investing heavy hitters like Michael Burry and Jeff Gundlach, and they're waving the red flag saying AI is way overblown. But then on the other side, you've got the insiders, the people actually building this stuff, like Eric Schmidt. And he's saying, you guys don't get it. This revolution is actually being underhyped. So who's right? All right, let's look at the facts, not the fear. Nvidia just dropped a third-quarter revenue number of $57 billion. That's a 62% jump. That isn't just hype. That's not bubble talk. That is real, tangible, massive spending happening right now. And hey, it's not just a one-off thing with Nvidia either. Take Palantir, a huge player in getting AI into big companies. Their revenue shot up 63%. Now look at that compared to the average company in the S&P 500. It's not even in the same league. This stuff is having a real, powerful economic impact. And just to put all this bubble talk into some historical perspective, let's do a quick history check. In the 5 years before the dot-com bubble popped, the Nasdaq went up more than 800%. 800. Our current 5-year gain? 95%? See, the scale, it's just not even comparable. So while things have run up, for sure, we are nowhere near the kind of speculative mania we saw back then. Okay, on to the next big fear factor, the economy itself. The data we're getting is just all over the place. It's sending these wildly different signals, and it has pretty much everyone asking the same exact question. It seems like such a simple question, doesn't it? But trying to answer it right now? Well, it's anything but simple. Let's break down why it's so confusing. So get this. On one hand, you have a major recession predictor that has been flashing bright red since 2022. And historically, this thing has a perfect track record. But at the exact same time, corporate profits are hitting all-time highs. And the credit markets, which are like the canary in the coal mine for financial stress, are totally calm. How can both of these things possibly be true at the same time? Well, the answer might be that we're looking for the wrong kind of recession. Jordi Visser has this really interesting thesis that this isn't your classic downturn. He calls it an AI-driven cleansing. Basically, it's creating this K-shaped economy. The companies that are embracing AI are on the top part of the K, soaring upwards. But the ones that can't or won't adapt, they're on the bottom part, faltering. It creates recession-like conditions for huge chunks of the economy without causing a total system collapse. All right, let's switch gears and head over to the world of crypto, specifically Bitcoin, because, man, it has been a painful ride lately. We've seen a nasty crash that has led to a ton of capitulation and just raw fear. I mean, think about it, a 36% drop from the highs, and it happened in just 7 weeks. A move that fast and that hard is just brutal. It completely wiped out a lot of the newer investors and really shook confidence across the entire market. But this is exactly where our rational framework comes back into play. As the price was crashing, look what happened to how people felt. The fear and greed index just plummeted to a 6 out of 100. A 6. That puts 94% of the market in a state of extreme fear. We're not talking about just being nervous here. This is pure, unadulterated panic. And you see, for a disciplined bettor, that level of panic isn't a signal to sell and run for the hills. It's a signal to pay close attention. Historically, when sentiment gets this washed out, when you see this level of forced selling, it often marks a major bottom. It's a classic contrarian sign that the worst of it might actually be over. So, okay, we've taken apart the fear around AI, we've looked at the weirdness in the economy, and we've dissected the panic in Bitcoin. Now for the most important question, how do we pull all of this together into a strategy we can actually use? Well, it all comes back to this process. It's a simple 3-step loop. First, you frame every single decision as a bet, not a sure thing. Second, you base that bet on the facts, the actual data, not the fear you're feeling in your gut. And third, and this part is absolutely crucial, you have to be ready to change your mind as new evidence comes in. You gotta stay adaptable. So if we follow that process, what are the facts telling us right now? Well, they're telling us that global earnings are actually looking positive, that growth forecasts for some overlooked parts of the market are huge, that the credit markets are stable, and that companies are adopting AI faster than ever. The key takeaway is that the underlying data is pointing to strength, not some kind of imminent collapse. And this quote from Annie Duke just brings it all home perfectly. The goal isn't to be right all the time. That's impossible. The real goal is to have a good process for making your bets. You have to judge yourself on the quality of your decision-making based on the facts you had at the time, not just on whether you won or lost that one bet. And that right there is the choice every single one of us has to make in this market. Because the noise from all the fear, man, it is deafening. But the signal, the one coming from the actual facts, seems to be telling a very, very different story. So the question I'll leave you with is, which one are you going to listen to? To learn more and stay up to date with the latest in the world of Bitcoin, visit exponentialtom.com and subscribe to the channel.